Welcome back. Today we are jumping right into a really compelling analysis on supermicrocomputer, or SMCI, titled Nvidia's Best Friend is on Sale.
A great title.
It is. The core argument is that SMCI is fundamentally undervalued because of its critical role with Nvidia's new chips. It really leans into the Blackwell catalyst and their big lead in direct liquid cooling.
And that framing, the Nvidia's best friend thesis, is definitely the report's greatest strength. It immediately establishes why this matters. The idea of the liquid cooling moat, specifically, it's powerful. It argues DLC isn't just an add-on, it's a requirement.
It is, but let's start there. While that Nvidia's best friend connection is the strongest pillar of the thesis, the analysis should more fully quantify the inherent risks of relying so heavily on one partner.
That's a huge point. I mean, the whole valuation rests on this one beautiful relationship. Any crack in that foundation is, well, it's catastrophic for the numbers.
Exactly. So the weakness right now is that the report establishes SMCI as this primary engine, but the risk profile it presents is, a bit too simple.
Right.
It mentions the risk of margins staying low, and okay, that's important. But that's secondary to the real risk, which is the durability of the revenue pipeline itself.
Yeah, building on that, has the report really explored what happens if there's a strategic shift, from Nvidia, or if competitors start to erode that dependency? The margin discussion is almost moot if the revenue itself is at risk.
We need to stress test the best friend status. So the suggestion here is to move beyond just listing the risks. The analysis needs to integrate formal scenario planning. It needs to address what happens if that competitive moat, that DLC lead, is replicated faster than expected. Or what if Nvidia just decides to strategically diversify its partners?
I like the idea of modeling that risk, but are we crossing a line here? Asking the analysis to model a, say, 30% volume shift? Isn't that basically asking for a whole new industry forecast?
Not if the entire valuation is built on this massive ramp-up. If the whole thesis is that SMCI is indispensable, then the analysis has to prove it. It has to hold up under stress.
Okay, that reframes it. It's about showing your work, demonstrating rigor.
Precisely. So how do we make that concrete? Well, one way is to look at historical precedent. What if competitors like Dell or HPE shorten their design cycles and narrow SMCI's building block advantage? What's the exact impact on that revenue ramp?
And for the diversification risk, you could model a specific scenario. Let's say Nvidia allocates 30% more GB200 volume to, Foxconn maybe, just to reduce its own risk.
Yes.
The analysis then needs to show how resilient that $36 billion target is under that kind of pressure. It makes the whole argument much harder to attack.
That's the exact kind of high-level modeling we're talking about. Okay, now let's pivot. Assuming the revenue pipeline holds, the next question Wall Street will ask is it profitable?
Which brings us to the margin compression.
Yes, that leads us right into the second key area for improvement. To overcome Wall Street's skepticism, the material needs to provide a more rigorous, data-driven defense for the recent margin compression.
And the report does flag this. It notes that margins dropped from around 13% down to, 9.3%? And that's what really spooked investors.
It is. But the rebuttal in the analysis right now? It relies almost entirely on what management is claiming, that the low margins are just due to aggressive market share capture and building out factories.
And the problem with that is it's just a narrative. It asks the investor to take a story on faith, rather than showing a quantifiable link between the capex, the factory spending, and the hit to operating costs. It feels like an excuse, even if it's true.
It weakens the whole valuation because it's not measurable. So the suggestion here is critical. Explicitly connect the short-term margin drop to those specific high-cost activities, the scaling of new liquid cooling factories.
And provide data points.
Yes, and provide projected data points for when margins will normalize, tied directly to volume milestones. You have to turn a management promise into a metric.
So if the low margin is a strategic investment, you have to forecast the return on that investment. It has to be time-bound. How do we make that concrete in the report?
Instead of just noting the claim about aggressive investment, the analysis could estimate, even broadly, the percentage of current operating costs that are directly attributable to that DLC infrastructure buildout. That isolates the cost drag for the reader.
And crucially, you give them the exit ramp. You could state that margins are expected to return to that 11 to 13% range, but only after Blackwell Ultra shipments hit a certain volume, say 2,000 racks of those advanced systems.
And you tie it to a specific quarter, maybe Q3 or Q4 of fiscal 26.
Right.
That kind of clarity transforms the justification from a weak excuse into a verifiable thesis. It gives the investor something concrete to measure success against.
Exactly. If Q3 26 comes and they've hit that milestone but margins are still at 9%, the thesis is broken. If they recover, it's validated. That strengthens the whole on-sale argument.
It directly addresses the fear of losing pricing power by reframing the low margin as a temporary strategic investment with a measurable ROI.
A scheduled return. I like that.
Okay, now for the third, and maybe the biggest psychological hurdle in the whole analysis, that $36 billion revenue target.
Yeah, the disconnect there is it's unavoidable. The entire bull case rests on hitting $36 billion for fiscal 26, but the last quarter was only $5 billion. That's a gigantic ramp up in a very short time. It feels like magic to a skeptic.
$6 billion target creates this huge gap. It leaves the analysis totally vulnerable to the speculative growth critique. The report should refine the presentation of this aggressive target to more effectively bridge that gap.
I wonder if by focusing only on the annual number, the analysis is sort of skipping over the mechanical steps. The growth isn't linear, it's supposed to be exponential, right? Driven by that Blackwell lock-in. The reader needs to see the curve.
Exactly. So the suggestion for improvement is to offer a more detailed, structured breakdown of the required sequential growth. Link the revenue ramp to specific product rollouts, specific phases, like the transition from older systems to the full Blackwell and GB200 deployment.
Grounded in operational reality. It's not just about selling more, it's about unlocking specific bottlenecks in the supply chain.
Right, so how can the report visualize this? Since the analysis relies so heavily on this target, provide a hypothetical roadmap, show the expected quarterly ramp needed to hit $36 billion.
So project the non-linear acceleration?
Yes. For instance, Q2 at $6.5 billion, Q3 jumps to $10 billion, and then Q4 spikes to, say, $14.5 billion. That illustrates the sheer scale of what's required.
Hold on, I want to challenge that Q4 spike. A massive jump like that, it implies something has to happen. Either a miracle or a major operational constraint is suddenly unlocked.
That is the critical missing piece.
For that sequential growth to be credible, the report has to identify the tangible catalysts required to support that huge jump in the back half of the year.
Is that Q4 jump tied to a specific liquid cooling factory coming online? Is it tied to a pre-negotiated volume increase from Nvidia that goes live on a certain date? What is it?
Making that link explicit, Catalyst A must happen for revenue jump B to occur. That transforms the $36 billion number from just a goal into a structured roadmap.
It moves it from optimism to rigorous analysis. The valuation becomes so much harder for Wall Street to dismiss if the path is clearly charted and tied to physical milestones. New factory lines, specific contract dates, not just abstract market share gain.
It really validates the analyst's deep understanding of the supply chain dynamics.